Something unprecedented just happened in the British property market, and the consequences are about to touch every single household across the country. Whether you're trying to save for your first home, trapped in the endless rental cycle, or sitting on what you assumed was a safe investment, the ground beneath your feet is shifting in ways most people don't even notice. Mortgage regulations have just undergone their most dramatic transformation in over 15 years. Thousands of landlords are abandoning their properties while corporate giants swoop in to claim entire streets. Behind the scenes, government advisors are quietly crafting tax proposals that could devastate millions of ordinary homeowners. And all of this is happening simultaneously, creating a storm that isn't random. It's a coordinated reshaping of the housing landscape. Think about it. If you miss what's happening now, you could spend years wondering why you were left behind. The stakes are huge. Your ability to own, rent, or maintain property depends on understanding the forces at play. In the past, market shifts were incremental, often slow enough to adjust to. But this isn't incremental, it's systemic. Regulatory changes, mass property listings, a landlord exodus, corporate consolidation, and looming tax reforms are colliding in ways that could fundamentally redefine who controls housing in the UK. The Financial Conduct Authority, FCA, released new guidance back in March 2025 that should have dominated every headline. But it slipped almost completely unnoticed. These new rules dramatically change who can buy property, who can secure a mortgage, and who may be excluded from the market entirely. Thousands of capable buyers were being rejected under the previous system, not because they couldn't afford repayments, but because stress tests assumed rates would skyrocket to unrealistic levels. Now, those restrictions are easing, giving more people the chance to borrow, but it also risks inflating property prices if demand outpaces supply. Meanwhile, landlords are fleeing and big institutional investors are waiting to capitalize. Small, family-run landlords who historically kept rents lower and maintained properties more personally are being squeezed out. Corporations with armies of legal teams and algorithms are taking their place, optimizing every aspect for profit and efficiency. Tenants are becoming data points rather than human beings, rent is rising, and the personal touch is disappearing. And just when you think that wasn't enough, tax proposals are on the horizon that could hit homeowners with properties worth over £500,000. In London and the southeast, ordinary family homes already exceed this threshold. A land value tax could trigger forced sales, price drops, and a chain reaction that nobody wants to experience. This is why paying attention now matters. This isn't just news. It's a survival guide for anyone involved in UK property. Over the next few minutes, we're going to break down exactly what's happening, why it matters, and how these forces connect. By the end, you'll have a clear picture of the risks, opportunities, and hidden forces reshaping the housing market in 2025. The question isn't whether you approve of these changes, it's whether you understand them well enough to make intelligent decisions for yourself. The first domino to fall in this housing upheaval is the seismic shift in mortgage regulations. Back in March 2025, the Financial Conduct Authority quietly released guidance that fundamentally changed how lenders assess borrowers. Since the 2008 financial crash, mortgage applications had been subjected to brutal stress tests. These weren't casual checks. They simulated scenarios where interest rates would spike 3, 4, or even more percentage points overnight. The idea was reasonable in theory: protect borrowers from overextending, protect banks from collapse, and protect the entire financial system from repeating the mistakes of the past, but the implementation became absurd. Even as the UK entered a period of declining interest rates in 2025, lenders continued stress testing as if rates were about to explode. They used punishing reversion rates, the rates you face once a fixed deal expires, then added further margin on top. The result? Thousands of perfectly capable buyers were being rejected for reasons that had nothing to do with their actual ability to pay. People who could easily handle their mortgage payments at real-world rates were being denied, sometimes repeatedly. The FCA's intervention changed all of that. They issued clear instructions to lenders. Stress tests must reflect realistic 5-year projections, not catastrophic hypotheticals. They emphasized consumer duty obligations, meaning banks must stop creating criteria that arbitrarily exclude people who can genuinely afford to borrow. This wasn't a minor tweak. It represented a substantial easing of restrictions, signaling that more approvals were coming, more transactions would occur, and market momentum was expected to increase. Then in July, the FCA went further. They overhauled the mortgage regulatory framework entirely, removing obsolete bureaucracy and making it much easier for people to switch lenders or modify their borrowing arrangements. Remortgaging became streamlined, borrowers could pay down loans faster without suffocating under paperwork, and exploratory conversations with lenders no longer triggered full regulatory advice protocols. Additionally, loan-to-income restrictions changed. From July forward, lenders issuing less than $150 million annually were exempted from the rules limiting high loan-to-income mortgages. Practically, this means more lenders can now offer 5 or 6 times your salary instead of the traditional 4 times ceiling. Combined with new government mortgage guarantee schemes for buyers with smaller deposits, the system is opening up rapidly. But here's the catch. Just because borrowing is easier doesn't mean affordability automatically improves. Increased credit can boost demand, and when supply is constrained, prices rise. The regulator's goal may be to stimulate growth, but history shows that growth fueled by expanded credit often inflates prices instead of helping ordinary buyers. And this regulatory earthquake sets the stage for the next force transforming the market, a flood of property listings that is catching buyers and sellers off guard. Following the regulatory earthquake, the next major force reshaping the UK property market is the dramatic shift in mortgage lending rules and government support schemes. The changes make it easier than ever for buyers to access credit, but the implications are more complicated than they appear. In July 2025, lenders gained unprecedented flexibility. Smaller lenders were exempted from restrictive loan-to-income caps, meaning they could now approve mortgages up to 5 or 6 times a borrower's salary instead of the traditional 4 times. This alone opens the doors to many buyers who previously found themselves locked out of the market. On top of that, the government introduced new mortgage guarantee schemes, designed to help buyers with smaller deposits secure a loan. For first-time buyers, this is potentially transformative. Suddenly, a 5% or 10% deposit can get you closer to owning a home than ever before. On the surface, it looks like a win for affordability, but digging deeper reveals a more complex picture. Easier borrowing doesn't automatically make homes cheaper. In fact, if supply remains constrained while demand surges, the opposite occurs. Property prices rise. More money chasing the same number of homes can push prices higher, potentially undermining the very affordability the schemes were supposed to create. This is where the idea of artificial support comes in. Government interventions are often designed to stabilize markets, encourage activity, and stimulate growth, but they also risk inflating prices artificially. Mortgage rules have been loosened precisely when the market is vulnerable, creating a scenario where more buyers have access to more credit at the same time that properties are being forced onto the market. The result is a delicate balancing act. Regulators want transactions to increase, but without careful oversight, this growth can create a feedback loop of rising prices and higher debt levels, leaving buyers more exposed. Another subtle effect is market psychology. When lending appears easier, buyers are emboldened to bid higher, sometimes stretching beyond what they would have under stricter rules. Sellers, sensing increased competition, may also raise asking prices. This pushes the market further into corporate favor, as institutional investors are ready to absorb these higher valuations, while ordinary buyers face tighter budgets and increased risk. Ultimately, the lesson here is nuanced. Yes, more people can now get mortgages. Yes, first-time buyers have new opportunities. But these moves may be less about improving affordability and more about stimulating market activity and sustaining property values. Easier borrowing meets another force, one that might look beneficial at first glance but has serious implications for everyday homeowners: the sudden flood of properties hitting the market. And this isn't a normal uptick. It's a tidal wave driven by expiring fixed-rate deals and structural pressures on landlords. Transition. The next section reveals why the market is suddenly flooded with listings, and why this apparent buyer advantage is anything but simple. The second major force is a flood of property listings, the largest surge in over a decade. Data from Rightmove and Zoopla show a jump of roughly 10% in homes listed for sale year on year, while demand has only increased by 4%. On the surface, this seems like fantastic news for buyers. More choices, more negotiation power, and the chance to pick the perfect property at a fair price. But the underlying dynamics are far more complicated and potentially destabilizing. The surge isn't coming from a healthy market, it's being driven by structural pressures on homeowners and landlords. Many properties sold during the ultra-low, Rate period of 2020 to 2021 were purchased with 2% or lower fixed-rate deals. Those deals are now expiring, forcing homeowners to confront sharply higher repayments if they fail to remortgage or adjust their loans. At the same time, new regulations and tax pressures are driving small-scale landlords out of the rental market.
These aren't optional sales, they're forced moves, often dictated by financial reality rather than personal choice. Short-term, buyers might feel empowered, but long-term, the flood of listings has two serious consequences. First, while more properties are available, demand isn't rising fast enough to keep prices climbing significantly. Zoopla forecasts suggest house price growth will slow to 1.52% in 2025, essentially flat when factoring in inflation. Second, the types of properties being sold are often less accessible to typical buyers. Landlords exiting the market are frequently replacing human-centered management with corporate buyers who plan to rent rather than sell or flip properties for profit. There's also the rental angle. While fewer landlords might seem positive for first-time buyers, it has the immediate effect of shrinking the rental supply, pushing rents higher. For tenants, this means rising costs without a corresponding increase in housing quality or availability. Meanwhile, ordinary homeowners hoping to upgrade or relocate face increased competition from institutional buyers with deep pockets. The market is starting to favor corporations with the ability to absorb risk and scale rapidly, leaving everyday buyers squeezed between high prices and limited options. This surge in listings isn't just a market statistic, it's a signpost of structural change. As more owners are forced to sell and corporations step in, the housing landscape is reshaping in a way that prioritizes institutional profit over individual stability. It sets the stage for the next layer of the crisis, the exodus of small landlords and the concentration of power in the hands of corporate entities. Understanding why landlords are leaving and who benefits from their departure reveals the hidden mechanics of inequality embedded in these market shifts.
One of the most striking shifts in the UK property market is the mass exodus of small-scale landlords. On the surface, this might seem like good news for tenants or first-time buyers. Fewer competing landlords should mean more accessible properties, right? But the reality is far more nuanced and alarming. Government initiatives, rising taxes, and stricter rental regulations are creating financial pressures that make small-scale landlording increasingly unviable. For many individual landlords who owned one or two properties as supplementary income or for retirement, the math simply no longer works. The consequences are profound.
According to the English Private Landlord Survey, small landlords historically kept rents below market rate, maintained their properties personally, and were more flexible when tenants faced hardship. They operated on relationships, not algorithms. Corporate landlords, by contrast, maximize returns systematically. Rent increases happen automatically based on data-driven models.
Maintenance is scheduled to optimize costs, not tenant experience. Evictions become faster and less negotiable. Guided by compliance teams and algorithms rather than personal understanding, this structural shift doesn't just affect tenants, it reshapes the entire housing ecosystem. Small landlords are often part of local communities invested in neighborhood stability. Their departure removes that human element and replaces it with impersonal, profit-driven entities. This creates a two-tiered system: tenants who can afford corporate rents and those left behind in shrinking, more expensive rental pools. Short-term affordability may seem neutral or even slightly better due to more properties being listed, but in the medium to long term, inequality deepens. The exodus also amplifies corporate consolidation. As small landlords exit, institutional investors move in to acquire blocks of properties, entire streets, and development sites. This isn't opportunism, it's a structural advantage. Large companies can absorb regulatory compliance costs, optimize operations at scale, and navigate tax complexities that crush individual investors. Ordinary landlords are left behind, while corporate landlords gain unprecedented control over both supply and rents. The societal implications are stark. Housing, one of the most essential human needs, is increasingly being concentrated in the hands of a few large players. This concentration not only affects rent prices and property values, it also erodes community connections, flexibility, and personal accountability in the rental market. For the average tenant or prospective homeowner, this means less negotiating power, less protection, and fewer options that align with individual circumstances. Transition.
This brings us to the next stage in the market transformation: the rise of institutional investors. Corporations like BlackRock, Legal & General, and Blackstone aren't just buying homes, they're controlling supply chains, development pipelines, and the very mechanics of housing as an asset class. Understanding their role is crucial for seeing the bigger picture. As small landlords exit, a wave of institutional investors is sweeping across the UK property market. This isn't casual investment. It's a strategic, long-term grab for control. Companies such as BlackRock, Lloyds Banking Group, Legal & General, and Blackstone are acquiring thousands of homes, entire developments, and even stakes in brick manufacturers and land banks. They're not merely purchasing properties. They're controlling the entire supply chain, from the construction materials to finished homes. This gives them unprecedented leverage over the market. The reasoning is simple. Housing is one of the safest and most profitable investment classes globally. Inflation drives rents upward, debt costs are often fixed or decreasing in real terms, and demand is nearly inelastic because everyone needs somewhere to live. Unlike discretionary spending, tenants cannot opt out. They must pay rent regardless of economic conditions. Institutional investors understand this fundamental principle, and they are exploiting it fully. The implications for ordinary buyers and tenants are staggering. When a landlord is an individual, there's room for negotiation, understanding, and flexibility during financial hardship. When the landlord is an algorithm driven by shareholder returns, tenants are simply data points. Rent increases are automated, maintenance is scheduled to optimize profit, and eviction processes are sped up without personal oversight. Human flexibility is replaced by corporate efficiency. Additionally, corporate dominance exacerbates market inequality. Ordinary buyers cannot compete with investors who have the capital, legal teams, and economies of scale to buy in bulk. Entire neighborhoods are being consolidated into corporate hands before individual buyers even have a chance to enter. This not only affects affordability, but also redistributes wealth and control in ways most people don't notice. Housing is no longer just shelter. It's a financial asset class, a generator of passive income, and a tool for long-term wealth accumulation. This transformation also has broader societal implications. Once corporations dominate enough of the housing stock, they influence household budgets, local economies, and consumer behavior. Rent becomes a fixed financial burden rather than a negotiable expense. Communities lose local ownership, and decisions about housing are driven by profit, not human needs. Ordinary people are gradually sidelined in a system designed to favor institutions. The last structural threat comes from tax proposals, which could further accelerate forced sales and corporate consolidation. HMRC's $15 billion from stamp duty in a slow market is just the beginning. Policy changes on the horizon could reshape homeownership fundamentally. The final, potentially explosive force reshaping the UK property market is taxation. Property has always been a reliable source of government revenue. In 2024 alone, HMRC collected nearly $15 billion from stamp duty, despite a slowdown in transaction volumes. But policymakers aren't stopping there. Leaked proposals suggest a land value tax could replace council tax and stamp duty, specifically targeting properties over $500,000. At first glance, this might seem like a tax on the wealthy. However, in the southeast and particularly London, ordinary family homes already exceed this threshold. Two-bedroom flats, modest family homes, many fall squarely within this tax range. The result? Middle-class homeowners, not oligarchs, could face substantial new financial burdens. Annual bills of thousands of pounds could force some owners to sell, while others may watch their retirement plans unravel. The consequences ripple through the housing market. Forced sales increase supply, putting downward pressure on prices. As prices fall, more homeowners could find themselves in negative equity, triggering additional sales. This feedback loop is difficult to stop once it begins. In regions where property values are concentrated, particularly the southeast, the impact could be severe, a sudden correction that erodes wealth built over decades. The political logic is clear. Older homeowners tend to vote, and taxing property is often seen as a way to raise revenue without touching income tax. Younger voters, who are often locked out of property ownership, typically support taxing property wealth. It's a tempting approach for governments seeking revenue, but the social and economic consequences could be destabilizing. Middle-class families, not just the wealthy, would bear the brunt, combined with easier borrowing, corporate consolidation, and the landlord exodus.
These tax changes could accelerate a fundamental restructuring of the market. Ordinary homeowners may find themselves competing with corporations for financial survival, while institutional investors gain more opportunities to acquire assets at discounted rates during forced sales. This is not a theoretical risk, it is already beginning to shape market behavior. When these five forces, regulatory change, lending shifts, property listing surges, landlord exodus, and tax proposals interact, the effect isn't additive, it's transformational. Understanding this interconnected system is essential for anyone hoping to navigate the UK property market successfully. Looking at all these elements together reveals a startling truth. The UK property market in 2025 is no longer operating as it did for decades. These forces, easier borrowing, a surge in listings, the exit of small landlords, the influx of corporate investors, and looming tax changes, are interconnected, each amplifying the effects of the others. What may seem like separate issues are actually part of a coordinated structural shift that favors institutions over individual homeowners. Easier borrowing, for instance, increases demand and inflates prices, allowing sellers to exit without crashing the market. Meanwhile, small landlords leave due to tax pressures and regulatory changes, creating space for corporations to consolidate ownership. Flooded property listings allow buyers to pick from more options, but many of those properties are being acquired by institutional investors rather than first-time homeowners. Finally, potential land value taxes could force additional sales, further accelerating corporate accumulation. The cumulative effect is a market increasingly dominated by a handful of powerful actors. Ordinary homeowners and small landlords are squeezed, while tenants face less flexibility, higher rents, and diminished bargaining power. Housing is transforming from something people own into something people rent from massive corporations, whose priorities are profit and shareholder returns, not community or tenant welfare. For everyday individuals, the message is clear: knowledge is power. Understanding these forces isn't about fear-mongering, it's about making informed decisions. Whether you're buying, selling, renting, or investing, recognizing how the market is being reshaped allows you to plan strategically rather than react passively. Policy decisions, market behavior, and corporate strategy are all moving in ways that might seem subtle day to day. But the consequences compound rapidly. For homeowners, being blindsided by these changes could be financially devastating. For renters, failing to understand the corporate takeover could mean paying significantly more for less flexibility. And for aspiring first-time buyers, the hurdles are growing even as opportunities appear to increase on the surface. The UK property market hasn't just shifted in 2025, it has been fundamentally restructured. Understanding the interplay of these five forces is crucial for anyone who wants to navigate this new landscape effectively. The future of home ownership, rental affordability, and property wealth is being written right now, and your decisions today will determine whether you thrive or struggle in the coming years. Stay informed. Share insights and discuss in the comments. This is a pivotal moment for the UK property market, and knowledge isn't just power, it's survival.